We put this all together in our house view fund, the Northstar SCI Managed Fund. Firstly, on SA equities, having been underweight our peer group for a few years, we've been lifting exposure of late to South African shares. Secondly, offshore equity, having been overweight our peer group for a number of years, in the last 12 months, we've made a big decision to drop offshore equities and reduce our exposure there. On fixed income in South Africa, we've remained constructive and continue to hold relatively long duration instruments. As far as property is concerned, we're yet to dive in. Although valuations have improved, we still feel there's a lot of pressure in that space and also quite a lot of excess capacity. Probably most notably in the fund, we've allowed our offshore exposure to diminish. Not just in terms of equity exposure, but as a whole, as our inflows in the fund have dramatically increased. So we've allowed offshore to whittle down from over 30% down to low 20s in the fund, while buying South African equities. We understand that there's risk in doing this. We understand the Moody's outlook might change, but we just feel currently valuations more than compensate us in the South African market and really don't in offshore markets. Probably the last part of this is all around the performance of the fund. We're proud to indicate that the Northstar SCI Managed Fund continues to perform well. We believe our asset allocation has been super successful in that fund from periods 1 to 4 years. And before that, we were probably a little bit light on equities when the South African market was running. But the last 4 years have been really positive in terms of performance in the fund, and we continue to improve the performance on a consistent basis. What has worked has been our asset allocation. What has also worked is the core true skill inside Northstar, which is stock selection. What's been hard on us, however, is the performance of commodities. Being a manager that has a philosophy centered around quality at a reasonable price, quite frankly, commodities do not easily fit into our philosophy. And it's difficult to justify owning high exposures to risky businesses. So over the last 3 years, as commodities have rallied, we've been fortunate enough to offset the return seen from commodities by picking stocks almost flawlessly inside the rest of the market. We've avoided numerous disasters, Steinhoff, etc., and we've managed to pick up some of the top performing stocks in the market outside the resource space. So our fund continues to do really well. And if you look at the major surveys out there, you'll notice quite clearly that for the risk that we run in terms of the fund, we have one of the highest returns in the market. We do not believe that this should change. Our processes are in place, and we have a philosophy that will generate long-term returns for investors.